Hey, welcome back to Compounding Quietly. Checking your portfolio value every day feels like control. It's actually the opposite. It's outsourcing your decisions to a number you can't influence.
That's a strange place to live in.
Let's look at why. Right now, a lot of investors are checking their portfolio value more often than usual. Markets move, headlines get louder, and the number on the screen becomes the thing that decides how someone feels that day. If it's up, they feel like they made a smart move. If it's down, they start questioning everything: the fund, the strategy, even themselves. This isn't really about the market. It's about what habit you've built around watching it. The portfolio value is a single snapshot. It reflects price on one day at one moment. It doesn't reflect whether your underlying holdings are still doing what you originally asked them to do. And that's the part most people skip. They treat a number that changes by the hour as if it were a verdict on a decision that was supposed to play out over years. Picture someone opening their brokerage app on a lunch break. The market had a rough morning, and the total at the top of the screen is lower than it was yesterday. For the next 10 minutes, that number quietly sets the tone for the rest of their day. They scroll through financial news looking for an explanation, find 5 different opinions, and end up more unsettled than when they started. Nothing about their actual holdings changed in that hour. Only their attention did. This habit isn't really about investing. It's closer to stepping on a scale 5 times a day and expecting a different number each time. The scale isn't wrong, exactly. It's just answering a question that has nothing to do with whether the underlying plan, the eating, the training, the actual structure is working. Checking more often doesn't produce more truth. It just produces more reactions to the same noise, dressed up as new information each time. Here's where the criteria needs to come back in. Your portfolio value was never the thing you were optimizing for in the first place. What you were actually building, if you're investing for the long term, was a stream of dividends, of compounding, of contributions adding up over time. That stream doesn't disappear because the price moved. It doesn't accelerate because the price moved either. So when the number on the screen swings and your reaction swings with it, you're reacting to something that was never the actual goal. You're reacting to noise and calling it information. What matters more than the number on your screen is whether the structure underneath it is still doing its job. Think about what you're actually holding. If you're in the accumulation phase, building positions over time, the relevant question isn't, what is this worth today? It's, is the income still growing? Are the businesses underneath still healthy? Am I still adding on schedule? Portfolio value can't answer any of that. It only tells you what someone else was willing to pay for your shares this afternoon. Picture an investor 3 years into a dividend growth strategy. The market drops 18% in a single quarter. Their portfolio value falls along with it, and the number on the app turns red. But the dividends being paid out by their holdings haven't dropped at all in some cases. They've actually increased because the underlying companies raise their payouts on schedule the way they have for years. That investor has 2 options. They can react to the price, sell some positions, and lock in a worse outcome. Or they can check the one number that actually matters for their plan, whether the income stream is intact, and recognize that nothing about their actual situation has changed. The habit of watching portfolio value pulls people toward the first option. The habit of watching income coverage pulls them toward the second. That's the real divide. Now picture a different investor. Someone already retired and living off their portfolio. For them, the stakes feel even higher because the number on the screen isn't just a measurement. It feels like survival. Their account drops during a rough quarter, and the instinct is to panic, to cut spending, to second-guess the entire plan they built years earlier. But the question that actually matters for someone in this position isn't the account balance. It's whether the income their holdings produce still covers what they need to withdraw each month. If the coverage is intact, the plan is intact, regardless of what the balance says on any given afternoon. That distinction is the difference between a retirement that feels stable and one that feels like a constant emergency. It's also worth noticing what these 2 investors have in common. Neither of them needed a better forecast. Neither of them needed to predict where the market was headed next. What they needed was a different number to look at, one that actually tracked the thing their plan depended on. Coming back to the original question, why? Watching your portfolio value is the wrong habit. It's not because the number is fake. It's because the number answers a question you're not actually trying to ask. You're not trying to figure out what your account is worth on any given Tuesday. You're trying to figure out whether the plan you built is still on track. Those are two different questions, and only one of them has anything to do with your decisions going forward. If you're in the distribution phase, pulling income out of your portfolio, this matters even more. What you need to know isn't the account balance. It's whether your income coverage ratio, the relationship between what your holdings are paying you and what you actually need to withdraw, is holding steady. A portfolio can drop in value and still fully cover what you need. A portfolio can also rise in value while quietly under-delivering on income. If the gains are coming from holdings that don't actually distribute anything, value and coverage are not the same measurement, and treating them as interchangeable is exactly the habit that needs to change. The direction here is simple. Build a habit of checking what the portfolio produces, not just what it's currently priced at. That single shift changes almost every emotional reaction that follows a market drop. None of this means you should ignore your portfolio value entirely. It still tells you something, just not the thing most people assume. It tells you what the market is willing to pay right now, nothing more. The structure underneath, the income, the contributions, the plan you built before the market got loud. That's what was actually carrying the weight the whole time. When you check your account from now on, ask a different question first. Not, what is this worth? Ask, is this still doing what I built it to do? That question doesn't move with the headlines. It doesn't spike when the market drops 18%, and it doesn't celebrate when the market jumps either. It just sits there, steady, answering the same way it did yesterday, because the criteria didn't change. Only the price did. A useful replacement habit is simple. Instead of checking the price every day, check the income once a quarter. Look at whether the payouts came in, whether they grew, and whether your holdings still match the reason you bought them. That single check takes a few minutes, and it answers the question that actually matters. The daily price, by comparison, answers a question you were never trying to ask in the first place. Your portfolio value will always move. Your criteria doesn't have to. That's not a small difference. It's the entire difference between reacting and deciding. The price is loud. The plan is quiet. Quiet wins. Compounding quietly. Slow, steady wealth building. If this helped, subscribe and leave a like. Everything here is for informational purposes only. All final decisions and responsibilities remain with you. Thanks for spending time with Compounding Quietly today.